Hi, welcome to Chapter 11, Part 2, all about corporations, how they're organized, the stock transactions, dividends, and retained earnings. In Part 2, we're going to look at issuing common stock, accounting for treasury stock, and some differences between preferred and common. Authorized stock. The company, in their corporate charter, indicates the amount of stock that they are able to sell. It is the maximum amount that they are authorized to sell. Now, a lot of times people think that that authorized stock has value. It does not have any value beyond the value of the paper the stock shares are printed on. They only have value when the stock is sold and ownership or piece of ownership is transferred to the stockholder in exchange for some asset, usually cash. When a company does an initial public offering, often called an IPO, initial public offering, the question always arises, how does the company set that price? And of course, we all know that ultimately the market will set the stock price. But for an initial public offering, they work with analysts, they work with advisors, they work with accountants, finance people, marketing people, and they look at a lot of factors. And these are some of the big ones. What the company's anticipated future earnings are. And that's, of course, based on, their position in the market. Do they have a new product? Do they have a new feature that no one else has? That sort of thing. They look at its expected dividend rate per share. Can the company issue dividends in the near future? How strong is its financial position? Financial position is another way to say balance sheet. We look at and then we look at things beyond the company's control, such as the state, the economy, and then what's going on in the stock market. And we've seen in the last few years quite a lot of fluctuation in the stock market, not always logical, that can adversely affect a company or in fact benefit a company. So the publicly held company's stock is traded in organized stock exchanges. The most commonly known one is the New York Stock Exchange. There's also the NASDAQ, the American Stock Exchange. And each of those stock exchanges has a little different portfolio in it. NASDAQ has more, for example, NASDAQ, then that's spelled NASDAQ, has more technology stocks, a higher percentage. That is where the buyers and sellers interact. That is where the price per share is negotiated. And of course, the prices fluctuate based on the company's earnings per share and dividends. So let's think about that. The chocolate company has an IPO and they sell a lot of stock, but they sell one share of stock valued at $30 to Joseph Blow. A year later, he turns around and sells that same share of stock for $40. There's a $10 profit. Who receives that $10? The chocolate company or Joseph? And the answer is Joseph earns the $10. The chocolate company does not receive the $10 at all. So it's great news for the chocolate company that their stock has risen 33.33%, but they don't realize that particular $10. We're going to learn a term, par value. We talked about par value with bonds and how the bonds that you studied had $1,000 par value. Stock also has a par value, and years ago it had more meaning than it did today. It's the legal capital per share assigned to a per share of stock. Today, states used to require this. Today, a lot of states don't require this anymore, and so you see a lot of companies with real low dollar par value, like $1 or even 1 penny a share. And board of directors have been known to assign a stated value to no par stock. The one good thing about par value is it enables you to calculate out issued shares of stock, and we'll go into that a little later. Remember the accounting equation. Who could forget? Assets equals liabilities plus stockholders' equity. Assets are the company's resources. Liabilities and stockholders' equity are how the company financed these resources. You have two choices in financing: debt, and we looked into that in Chapter 10, and equity. And that's what we're doing now. The owners, they own a piece of the company. Equity has two areas, two sources. One is paid-in capital. These are owners who buy common stock, or we're going to talk in a little bit about preferred stock. And those are separate accounts, and they're called common stock and preferred stock. And each of those has a extra account, an additional account associated with it. And it's called paid-in capital, or abbreviated PIC, in excess of par value. So if they sell the stock with a par value of $1, but the market's risen and it's selling now for $3, $1 would go in the common stock account and $2 would go in the paid-in capital in excess of par value account. That's paid-in capital. That's what the owners are putting into the company. Earned capital is with the retained earnings account. Earned capital is what the company earns with the assets that have been financed by debt or equity. In other words, it's the income statement net income, of course, less any dividends that the corporation pays out to stockholders. And it's got that name, retained earnings, because the company's retaining it for future use. Okay, so let's look at common stock and the paid-in capital accounts. All right, in this area, paid-in capital, let's take a journal entry. Assume that McLean Inc. issues 2,000 shares of $1 par value common stock. A. Prepare McLean's journal entry if 1,000 shares are issued for $1 per share. So this would be highly unusual. You would actually sell the stock at its par value. Now I'm going to ask you to stop, and if you haven't done it yet, please pull out your course pack and follow along and actually write these journal entries down. That'll make it easier for you to do your homework and then your quizzes and then prepare for the exam. Okay, so here's the journal entry. Debit cash, credit common stock. There's no additional paid-in capital because we sold the stock at par value. Now let's look at journal entry number 2. These same shares, what if these same shares were sold, what if additional shares were sold, an additional 1,000 shares for $5 per share? Well, we would collect $5,000. What do you do for the credit? Well, you can't credit common stock for more than par value, and that's what we do. And this is when we use that paid-in capital in excess of par value account. And yes, this is an account. It's a very long title, but it is an account. In practice, this account is also called additional paid-in capital, and in practice, it's abbreviated to APIC or APIC. So after these two offerings were made, you have $2,000 in the common stock account, $4,000 in the paid-in capital in excess of par value account, and I just put in a number for retained earnings. So you have the two areas, paid-in capital and retained earnings, for total stockholders' equity of $33,000. Okay, what if this stock were no par value? What if this stock had a stated value of $5 a share? What accounts would you use now? So you sold it for $8 a share. So that's $8 times 5,000, which is $40,000. And now we still have the common stock at par value. And what do we do with that difference? It's paid-in capital in excess of stated value. So the account title changes, but the basic journal entry is the same, and the calculations are the same. This is an example of a journal entry for stated value. What if there were no stated value? What if this were true no par stock with no stated value? Then and only then can you credit common stock at cost. So if there's no stated value, no par value, you credit common stock at cost. In every other situation, you separate the components as to the par value piece and the additional paid-in capital. What if you are really cash poor as a startup company and you want to trade stock for services. Your attorneys believe in the company and they're willing to take shares of stock in consideration for their services. Or suppose you want to buy land, building, computer equipment, and the same situation occurs. Let's take an example. The attorneys for Bruce Company bill the company $25,000 for their services. They agree to accept 24,000 shares of $1 par value common stock in payment. Now, there is no available market price for this stock. So there's nothing the company can look at and say, what is the value of this stock? But what they can say is, what is the consideration being offered? And the consideration is the $25,000 in services. So that becomes the basis for this journal entry. Organization expense is charged $25,000. Common stock, it's $1 par, is charged $24,000. And the balance, paid in capital in excess of par, is charged $1,000. So in this case, because there was no available market price, we used the consideration given up, which was the legal expenses. Okay, let's take another example. Let's assume that Athletic Research is an existing, publicly held corporation. Its $1 par value common stock is actively traded at $6 a share. Okay, actively traded at $6 a share. Now we have a value, an established value. The company issued 10,000 shares of this actively traded $6 a share stock to buy land. The land offering price was $80,000. How do you value the land in this transaction? $80,000 or $60,000? Well, you now have a price that's established. And that's what you're going to use, the $6 a share. And while it's true that the land was advertised at $80,000, what was given up in the exchange was something worth $60,000. So that establishes the purchase price of the land. And again, common stock at par value, and then the additional paid in capital for the balance. Okay, take a minute, stop the video, and do problem 11.1b and work on these issues. You will find the solutions at the end of part 3 in the PowerPoint slides.